Working capital is the amount of capital required to run the business, to meet the day-to-day expenses of the business. Whatever is the capital which is needed, we call that to be as working capital. Okay. The capital available for conducting the day-to-day operations of the business, day-to-day operations of the business, to run the business, to meet the expenses which incur day to day. So that is called as working capital. Okay. All aspects of both current assets and current liabilities need to be managed. What does it mean? Now, I think day before yesterday, I have explained you the logic of working capital from the balance sheet. If we look into the balance sheet, there are broad classification of assets. There are two types of assets: current assets and fixed assets. Then on the liability side, we have three different types of liabilities. One is related to the short-term period, which is current liabilities. The rest of them are for the long term. So long-term liabilities plus the equity. So these two are for the long-term period. Now, generally, we are only aware of the equation of working capital in the short run. So we just take the current assets minus current liabilities to be as the working capital. Okay, I also gave you the other equation of what is working capital. For the moment, let's not look into that one, but then just understand that what is what is working capital. Working capital in an equation form, looking at the short-term position, can be recorded as current assets minus current liabilities is working capital. So first we need to understand what is the meaning of current assets, then current liabilities, and then what is the meaning of working capital. Current assets are those assets which can be converted into cash in a period of 1 year or operating cycle, whichever is longer. So the meaning of current assets is those assets which can be converted into cash. So the convertibility is there, converted into cash in a period of 1 year or operating cycle. We will also look into what is the meaning of operating cycle. 1 year or operating cycle, whichever is longer. Okay, this should be longer. It's not the shorter or whichever is smaller. That is not the case. Whichever is longer. And if we talk about the current liabilities also talk about those liabilities which have to be discharged in a period of 1 year or operating cycle, whichever is longer. Here, what is that which is emphasized is cash is not kept available all the time, because cash kept in the form of cash is doesn't give any returns. So more or less, it is absolutely nothing that which can be earned from cash balances. So the amounts are not kept in the form of cash, but they are invested into some type of asset. From assets, return can be earned. So if the assets are invested for a longer period of time, the funds are blocked in those long-term assets. So some of the assets should also be invested into short-term assets wherein they get converted into cash, so that whenever they get converted into cash, the available cash can be used to pay the current liabilities and also meet the day-to-day expenses. So that is the purpose of investing into short-run assets. So current assets. Okay. ఇంట్లో పిల్ల ఉండిందే one second, just a minute. Sorry about it. The current liabilities are to be discharged in a period of 1 year. So to meet the current liabilities, so meeting the current liabilities is an important thing. See, uh, those liabilities which are to be met in the short run period, if they cannot be paid within the due date, if that is the situation, if that is the situation, then the reputation of the business gets affected. So if the creditors feel that the business is unable to make payments in future, the other stakeholders will not be willing to be associated with the company. So for that reason, meeting the current liabilities on the due date is very, very important. So to meet the current liabilities, some way there should be cash availability. In some form, there should be cash availability. So cash availability would be there if they invest amounts in short-term assets, current assets. Okay. So current assets are get converted into cash, and that cash is used to meet the current liabilities. Yes. But then what about the other expenses which are to be met? If not, it is not only the current liabilities which have to be paid, but more than that, also they need cash. So cash is needed to meet the day-to-day expenses as well. For that reason, the investment made in current asset should be much higher than the current liabilities. Ideally speaking, we say that it should be 2:1. So as much as the current liabilities are, double the amount of current assets should be invested into, so that this gets converted into cash, and that cash can be used to meet the current liabilities, plus the balance of the amount will be used for running the business, so meeting the day-to-day expenses. I said the definition of current assets and current liabilities we looked into as um, 1 year or operating cycle, whichever is longer. So we also have to understand what is the meaning of operating cycle. So the amount which is invested into um, the current assets, now the time period which it requires for the amount to get converted back into cash is the time period which is required. We refer to that as the operating cycle. So um, the first step is the amount of cash is invested into material. So material has to be purchased so that the activities can be carried on. To produce and sell the goods, first step is raw material has to be purchased. This raw material gets converted into finished goods. So it doesn't get instantly converted into finished goods. So if it is converted into semi-finished form, we call it as work in progress, then finished form, and then uh, when these goods are sold, if they are sold on cash basis, immediately cash will be received back. So the investment made into raw material, after it gets converted into finished goods and sales are made, cash will be received. But if at all these units sold are on credit basis, the sales gets converted into receivables. Okay, receivables, and receivables definitely have a credit period. Okay, usually we see 1 month, 2 months, or something. So until the credit period expires, at the end of the credit period, the amount of cash is paid back to them. So the cycle which which the amount of cash goes through. Okay, the amount of time period which requires for the cash to get converted back into cash, we refer that to as operating cycle. Here we see that the operating cycle now, there is a benefit here if the material is purchased on credit basis. The way the business sells goods on credit basis to the customers, so also the suppliers provide the material on credit basis. So immediately they need not invest their cash, but the credit facility which is extended by the supplier, that is utilizing that, the amount is mm, uh, the amount of material is purchased on credit basis, so that gets shortened. So the operating cycle shortens by that period of credit which is extended by the supplier to the business. So when we write the equation also, at that time we look into that and we write that. So now operating cycle or 1 year, we are talking about these two things, 1 year or operating cycle, whichever is longer. See, some of the businesses operating cycle is within 1 year period, but some of the businesses like heavy industries, the machinery equipment which are manufactured and produced, the operation, the production activity itself takes more than 1 year. In such a situation, if it is more than 1 year, then it is not possible for them to get back their cash in converted it again into cash. So the investment made into material will not convert back into cash in a period less than 1 year. Therefore, we take that to be as a period as 1 year or operating cycle, whichever is longer. So current assets are those assets which can be converted into cash in a period of 1 year or operating cycle, whichever is longer. Similarly, current liability is also in the same way. Now, what is working capital? Working capital is excess of current assets over current liabilities. So after meeting all their current liabilities from the cash which gets converted by way of converting current assets, after meeting the current liabilities, any balance, any surplus amount which is available is called as the working capital. Okay. So what is cash operating cycle? Cash operating cycle in terms of period, the equation can be recorded as the inventory days. How many times does it take for the inventory to get converted into finished goods? So inventory days. The stock, how long is the stock held by the business? From the day the material is received until the material is converted back into finished goods. So what is the time duration? The how long is the inventory there with them, held with the business? Inventory holding period or stock holding period, what we call it as. The number of days of inventory wherein inventory is there in the stores department or in the business. Okay, so unless and until inventory is converted into finished goods and it is sold, until the sale is made, cash is not possible to be collected. So it doesn't get converted into cash. That's the first part of it. The second part of it says the if the goods are sold on credit basis, now this period is further extended by the receivables period, the receivables day. Receivables days, for how long is the credit period extended to the customers? So first, initially cash is held in stock. The second part of it is now cash is held in receivables. From stock, it is moving to receivables. Okay, so that's the duration for which they have to wait so that cash gets converted. But yet there is another benefit also, facility which is extended by the supplier. The supplier has to be paid. Okay, supplier has to be paid at the end of the credit period which he is extending, the supplier is extending. So that's a benefit which is received. So that duration, payables day, has to be deducted from the total amount of time on account of the inventory and receivables into which the cash is held. So from that, payables days are deducted. So this is length of the operating cycle. Operating cycle, cash operating cycle in days, in number of days, the length of the cash cycle, whatever is the way in which the question is asked. This is the equation: inventory days plus receivables days minus payables days. Okay. The amount of cash required to fund the operating cycle will increase as either the cycle gets longer, the level of activity or sales increases. The amount of cash required to fund the operating cycle will increase. When will it increase? More amount of cash has to be pumped into the operating cycle because the operating cycle gets longer, either because there is a delay in the production process or because the credit period to the customers is extended. So if it is if it becomes longer, if the period extends, then to meet the expenses of the business they would not have funds, so the requirement of cash will increase by that amount. So more amount of cash will be um, uh, need to be raised from other sources, and they have to be invested into this operating cycle, so more amount of cash will be required. Okay, either the cycle gets longer or the level of sales increases. On account of that, more amount of cash, a level of sales increases, more amount of production has to be taken up to produce more investment into material has to be made. So these are the reasons. To continue with the cash operating cycle, okay, cash operating cycle reduce cycle time by the ways in which the operating cycle can be reduced. Okay, the first one is improving production efficiency. Why are we looking at reducing the operating cycle? One minute. Why should we think about reducing the operating cycle? So that is important here. So the operating cycle, various stages. Uh, how can we reduce the cycle time? Is the first one is, if the operating cycle is extended or it is for a longer period, there are additional costs which will be incurred. First one is, see, the amount of cash which is invested is borrowed from some source. So cash is borrowed. As it is, the business doesn't have any funds on its own, so it has to raise the funds from whatever is the source of capital, short term, long term, whatever is that. So the funds are raised, on which there is finance cost, the cost of capital has to be paid. So finance costs are to be incurred on the investment. So if the period is longer period, the cost also will increase by that amount. So as many number of days it is extending or it is longer, the finance cost will be higher by that amount. Then that is one thing. Second one is, the raw material which is purchased gets converted into work in process. Work in process gets converted into finished goods. So all of them are basically in the form of inventory. So inventory has to be stored in the business. So there are storage costs which are needed. See, the material has to be properly kept. So arrangements have to be made. A place should be made, arranged. Then bins or racks or shelves or some measures or some way in which the material, the inventory should be properly stored. So that also requires storage costs. So if it is for a longer period, more amount of cost will be required to be invested. So cash which is invested into inventory, in any form of inventory, raw material, work in process, finished goods, all of them require cost of storing them. And the very fact that investment is made attracts finance costs. Okay. So for that reason, the operating cycle has to be reduced. So what are the ways in which the operating cycle can be reduced is what we will look into. First one is by improving production efficiency. By improving production efficiency, what does it mean? To see that they are efficient in terms of producing the output. There is no delay at any given point of time. Very quickly, the conversion of raw material into finished goods happens, and then um, they are kept available for sales. So, improving production efficiency. So, very quickly, without any delay, if there is an order from a customer that is met immediately or within a short period of time, without delaying any further. So improving production efficiency, improving finished goods and or raw material inventory turnover. Okay. Um, what is the formula for inventory turnover?
Inventory upon cost of sales into 365.
No, no, no. You're talking about into 365, the number of days, but only the inventory turnover. Turnover ratios, the one which you gave is correct, but that will be the stock holding period. The that is 365 days. When we are taking into consideration 365 days divided by the inventory turnover ratio, talks about what is the inventory holding period. First part of it is only the turnover ratio. Inventory turnover ratio is one way to remember turnover ratios are all turnover ratios indicate the efficiency, whether they are efficient enough to convert the that particular investment into that variable, whatever is the variable, if it is inventory, if it is receivables, if it is assets, fixed assets, current assets, no matter what is the turnover ratio, all turnover ratios talk about the efficiency. So in that case, turnover, the second part of the um, for every turnover ratio, the second part of the ratio, the turnover part of it goes to the numerator, and the first part of it goes to the denominator. That is how we have to remember. So in the denominator, we would have the inventory. Okay. The numerator inventory, the numerator turnover, generally we refer turnover as sales. Sales is turnover. Okay. So the numerator should be turnover, but uh, uh, the term turnover takes varied forms according to the ratio what we are calculating. Here in case of turnover ratio, if we are writing turnover, it would be sales by inventory. But inventory is always at cost. Inventory is valued and recorded at cost in the books of accounts. Turnover is cost plus profit. So there is a profit margin which is added. So if there is a profit margin added, the comparison as the amount with profit margin included, amount without any profit margin included is not appropriate. So eliminate the profit margin and then stick only to the cost of those units which are sold. So that's the logic here. Okay. Cost of goods sold divided by inventory. That's how we remember. Okay. So what do they indicate? Inventory turnover ratio, what does it indicate? Improving finished goods or raw material inventory turnover. Turnover is this, the efficiency is reflected when the investment into the variable gets converted into the turnover. So how quickly the inventory gets converted into turnover is reflected by the inventory turnover ratio. So any investment which is made into any type of asset, it should very quickly get converted into turnover. If it is not converted into turnover, the amount is held or blocked in that particular variable, in that particular type of asset. So efficiency is known only when there is turnover made. Okay, there is turnover realized, that is that gets converted into turnover. So here it says that measures should be taken to quickly convert this finished goods or raw material or whatever is the type of inventory into turnover. So when it gets converted into turnover, then only there is a possibility of cash being realized. If it is not, any amount of investment made into huge amount of material is purchased also, it would be just blocking of the capital. Unless and until this gets converted, some activity is realized, it is of no use. Okay. So that's the next one. Third one talks about improving receivables collection and payables payment period. See, the receivables are what in the Indian context, what we refer to that as sundry debtors, what we call it as. Okay, but of late, I think everybody is using the term receivables. Okay, now receivables arise on account of credit, making credit sales. Okay, on account of credit sales. What is the reason why credit sales are made? The reason why credit sales are made is um, to attract more customers. So when credit period is extended, more number of customers get attracted. Okay, credit sales. The impact of credit sales is, see, even if those customers who are not so particular about purchasing the product also, once the credit period is offered, they tend to buy that because they are under an impression that they do need not pay immediately. So credit sales result in increase in sales. Sales increase whenever credit facility is extended to the customer. So it's a strategy which is adopted to increase the sales. Okay, a strategy adopted to increase the sales is credit sales. Fine, that is a benefit. But if the credit period what they are offering is for a longer period of time, as long as the period is, the finance cost again increases. So whatever benefit they realized, that would be nullified there. Therefore here what has to be looked into is a strategy to attract customers, but they should not go any beyond the regular, I mean, a minimum amount of credit period. So only as quickly as possible, they have to collect the amount back from the customers. So strategy is to get benefit, but at the same time, if they are also bearing additional cost, then there is no point in going for credit sales. Fine. So therefore, even if they make credit sales, they should think about collecting as early as possible. The strategy should be collecting as early as possible. Okay, that's one thing. On the other hand, the credit purchases, the credit purchases are um, those purchases which are made on credit basis from the supplier. Supplier is providing some credit facility, but this time it should not be paid as early as possible, delay as much as possible. Not that they would affect the reputation of the business, but delay it as much as possible, so that they get benefit out of utilizing their cash amounts for meeting some other expenses. So the strategy should be make this as longer as possible. As much credit period is extended by the supplier, utilize it. Okay, extend the credit period, but at the same time, it should not be that they leave an impression that they do not pay on time. So that also should not be there. The reputation in no case should get affected. Extend the credit period to make the payment. So these are the ways in which the operating cycle or the cycle time can be reduced. The way in which the cycle time can be reduced is, first one is, see that they are efficient in producing the products. So in a shorter period of time, they would be converting their inventory into finished goods so that they are kept available for the sales to be taken up. So sales can be made out of that. Second one is the finished goods or raw material inventory turnover has to be improved. So it should reflect that the inventory purchase should be as early as possible, as quickly as possible, get converted into sales. Then we see improving the receivables collection. So collect the amount from the customers as early as possible. And second, then the payment period, the payables period, payment periods should also be improved. Is utilize as much credit period is allowed. Then what are the working capital ratios? So the working capital ratios, you understand what these are because you've already studied them under management accounting. So we'll go through that very quickly. Current ratio, the first one is current ratio is equal to current assets minus current liabilities. Quick ratio is equal to all current assets except inventory. Okay. An advanced version is even we do not consider the prepaid expenses also. If there are any prepaid expenses, those also cannot be converted into cash. It's almost like they cannot get converted into cash. Only thing is out of prepaid expenses, the benefit can be realized. So that is the only benefit there. So apart from inventory and the prepaid expenses, all other current assets are quick assets. So take quick assets divided by current liabilities. Then we have receivables collection period. Receivables collection period in number of days is the number of days in a year divided by receivables turnover ratio. Receivables turnover ratio is sales by credit sales divided by receivables is receivables turnover. So that is that fraction goes to the denominator. 300 out of 365 days, what is the receivables turnover in the denominator? So the fraction, when it goes to the numerator, it reverses. So we see receivables into 365 by total sales. Similarly, the payments period also payables into 365 by total purchases. Otherwise, if we have the information as what are the daily sales or what are the daily purchases, we can take it as total receivables divided by daily sales or total payables divided by daily purchases. The other ones, inventory holding period, inventory turnover ratio, once we calculate what is cost of sales by inventory. Now, when that is gone to the numerator, it reverses. When it goes to the numerator, it reverses. Very much fan bandega. Right. And pencha ఇక్కడ బంద్ చేయి. Second button. Second button. Second button. కింద అంతే. Okay, inventory holding period is inventory turnover ratio, which goes to the denominator. 365 days divided by inventory turnover ratio. So that goes to the numerator. We see that inventory is in the numerator divided by cost of sales into 365. Okay. The operating cycle. Now we've seen the stages in operating cycle. Cash, uh, from cash it is raw material. From raw material it is work in process. From work in process we see it gets converted into finished goods. So there are various stages in the operating cycle. So very specifically we can also calculate it for each component of the working capital. So this gets converted into finished goods. If finished goods also um, finished goods then later on get converted into receivables. So there is a receivables period. At the end of the receivables period only, the collection period, the amount is converted into cash. So instead of very broadly looking at as inventory, receivables, payables, it can be looked into as each component of it. So the first investment is into raw material. So this can be split further in manufacturing companies as the first one is raw materials. So how do we calculate? What is the total stock of raw materials divided by raw materials usage, okay, into 365. So it says that usage cannot be calculated. Purchases gives a good approximation. So what is the um, usage of raw material, how is it used, or how many units, or what is the quantity of material which is consumed when it is given. We substitute that and then we find out the requirement of capital to be made into raw material. Then the second part of it is work in progress or work in process. So work in progress divided by cost of production into 365. Finished goods is stock of finished goods divided by cost of sales into 365. Then inventory turnover, total cost of sales divided by average inventory held.
Ma'am, can you please go back to the previous slide?
Yeah. So how much, I mean, we are looking at what is the amount of working capital. So what amount of working capital is required to be invested into each specific component of the operating cycle: raw material, work in progress, finished goods, inventory turnover.
Ma'am, for the inventory turnover ratio, why do we take the total cost of sales and not the total turnover?
Inventory is always at cost value. We see inventory, so the turnover ratio, the numerator should be sales. Turnover is sales basically, but because the inventory is valued at cost value, okay, inventory is at cost value, so the sale value is cost plus profit. Sale is cost plus profit. So a higher amount of sales could be on account of a higher profit margin included. So it would not be appropriate to compare sales with the inventory. Sales is cost plus profit. So higher sales is maybe on account of the higher amount profit margin which is added. Therefore, eliminate that profit margin. So stick with what is cost of goods sold. So cost of goods sold. So that is the logic in taking that. Then we see that the denominator is average inventory. Here you see this particular thing, which is average inventory. When do we use average? In this ACCA material, they are not very particular about going with the variable as average inventory, average receivables. But the logic about when do we use average is uh, when we are calculating ratios. So there is one numerator value, one denominator value. If one variable comes from the income statement, another variable comes from the balance sheet, the variable that comes from the balance sheet should be taken as an average. The reason is the income statement considers all the transactions during the year, starting from the first day until the last date. All of them are considered. The summary of it is reflected in the income statement. Balance sheet is not the case. Balance sheet is the values which appear as on the last date, as on the last date of the financial year. Whatever is the value of the assets and liabilities is recorded in the balance sheet. So the balance sheet values also should consider 1 year period. Therefore, the beginning values, the opening values, or the last year ending values are the beginning values of this year. So the beginning values plus the ending value divided by 2, average. So therefore, cost of goods sold is from the income statement. Inventory is the closing inventory, which is from the balance sheet. Therefore, this inventory should be recorded as average inventory. That is the logic here. Is that fine? Is it clear?
Yes, ma'am.
The next topic is how do we manage inventory? Okay. We're specifically looking at the inventory part of it. Inventory, how do we manage inventory? It says that it needs to maintain a balance between liquidity and profitability. Um, Liquidity will be low inventory levels, and profitability would be sufficient inventory to meet customers' needs. Okay, so ideally speaking, how much inventory should be maintained? Now, in the operating cycle, we see that the amount is invested into inventory. This amount to get converted into cash, it is going through one big cycle. Okay, so the main reason why the operating cycle is extending is because too much of investment is made into inventory. All this inventory, unless until it is sold, it will not be converted back into cash. But why is inventory purchased so much? Okay, there are reasons why inventory is purchased in bulk quantity. Production process is a continuous process. So when continuously the production activity is taken up, raw material has to be supplied. So if there is no material available, if inventory is not available, the production process would be stopped. But yet there are certain other costs also will be incurred. Overhead costs will be incurred, and with no production, then that will be resulting in a loss for the business. So on that note, material should always be kept available in the stores and continuously supplied to the production department. One important reason. When material is purchased in bulk, discounts also can be availed. That's another reason. Okay. Additional material more than whatever is to be produced, additional material is also purchased because anticipating that or kind of providing it as a cushion in case if the demand for the product suddenly increases. So at that time they should be equipped to provide this products to that increased demand immediately. So it acts like a cushion, it acts like a provision which they have already made to meet that unforeseen circumstance. Okay, so it's always that additional amount of material is purchased and kept available. One is, the main reason is the production should be smoothly carried on. Okay, it should not be stopped on account of non availability. Second reason, discounts can be availed if they purchase in bulk quantity. Then um, also to meet any additional demand arising in future. So for these reasons, we see that inventory is purchased in bulk quantities. Fine. So a lot of inventory is purchased in bulk quantity. They are thoroughly equipped. They can see that all their activities are smoothly carried on. They can provide the finished goods to the customers on time. Everything is there. Okay, but this requires certain costs, like they have to be stored in the stores department. So storage costs are needed. So the benefits are fine. Everything will be carried on smoothly. We can meet the demand of the customers, but this is increasing their storage cost. Second one, if they maintain low amount of stocks, in that case, there may be a problem with the availability of material to the production department. That is a possibility. Second, um, they cannot avail those discounts. Okay, third one, suddenly when there is additional demand arising, they will not be able to meet the customers requirements. So that impacts their profitability. So when sufficient material is not available, that will have an impact on their overall profitability. So for that reason, there should be a balance between what's the maximum limit and what's the minimum limit. So they always have to maintain this balance of inventory. So if it is a low inventory levels is affecting something. High inventory levels, sufficient inventory levels to meet customers thing is affecting another thing. Low inventory is impact having an impact on their liquidity. High amount of inventory levels ensures profitability. So high inventory ensures profitability. Low inventory affects the liquidity. Liquidity is inability to convert it into cash and make the payment to the current liabilities, payment for the current liabilities. So there is an issue with low inventory level, that is they will not have sufficient funds or liquidity is affected. High amount of inventory will ensure them the profitability. So too much of investment in inventory is also not advisable because their storage cost will drastically increase. So therefore, ideally speaking, what is the right amount of inventory level has to be decided, and that amount of inventory level should be maintained. To support us in that particular thing, there is one concept called as economic order quantity. Economic order quantity, which is used to decide on how many units or how much of inventory should be maintained. Okay, um, let's say on a scale of inventory, if this is zero number of units, and let's say that this is the maximum requirement of material. So in the maximum possible amount of material which would be required, um, given any particular situation, what is the maximum inventory level. So if we put it on a scale of inventory starting from zero number of units until the maximum number of units, in that case, um, when material is maintained at the maximum level, it doesn't remain at the maximum level all the time, because material is issued to the production department, it is used, it is consumed for whatever is the purpose, so it keeps decreasing. So as the material is um, issued to the production departments, or from the inventory they are moved to other departments, or they are moved to the warehouse for selling them. Okay, this inventory, when it is consumed, it keeps decreasing. Okay, so when it keeps decreasing, I mean, should they wait until it reaches the zero number of units so that they can place another order? That is a decision which has to be looked into. Material generally is not instantly purchased. It is not that they walk into a showroom and then buy material and then see that that is kept available. That is not the way in which material is purchased. Okay, material to purchase, the conventional way of purchasing material, the suppliers are asked to um, provide their quotations or submit their tenders with the prices, the details about price, quantity, quality, etc. Those details are they are the suppliers are called to submit their quotations. So they submit their details, and from among the suppliers, one supplier is selected. Order is placed with the supplier. On placing an order with the supplier, supplier delivers the material to the business. Okay, when they deliver the material is received at the factory gate. It is inspected in terms of the quantity, quality, and the other aspects. After inspection, they move to the stores department. So this procedure is a time taking procedure. So that's the conventional way of placing. Of late we see that it is little different, but it is again not instant. That is, we see that electronic platforms are available, like the suppliers details are all there on the electronic mode. There are internet platforms available, suppliers are there on that. So whatever are the details which are provided by the suppliers, supplier is selected and an order is placed with the supplier. But yet again, when they supply the material, it is immediately they cannot, so they also need some time to deliver the material. Then the rest of the procedure, that is quality is inspected, then it is placed or it is returned or whatever is that. So even in that the modern with the help of technology, the supplier is selected and an order is placed also, it is again not done instantly. It requires some amount of time. So let's say let's for a simple example, let's say that 10 days time is required for the procedure to be completed and the material is received from the supplier. So during that 10 days time, okay, that 10 days time is called, there is a term for that one as lead time. So during that lead time, whatever is the consumption which is required, how many units which are required during this lead time. So even before they reach that 0 units, so at least maybe say that 10 days inventory level which is still available or something like that. Until when once it reaches that level, there is another order which is placed. This is called as reorder point. At a point when they reach that, they place an order, reorder point. Okay, so then order is placed here, and then even after the order is placed also, the material keeps decreasing. So ideally speaking, so every business, they maintain one safety stock. So that is the worst scenario. So any situation, they ensure that the stock level doesn't go below that safety stock level. So ideally speaking, it should be, by the time the material, the new order of material which is received, it should be at the safety stock level. So if this is the reorder point, at this point when the inventory level comes to this point, an order is placed. But this time, how many units of order would be placed? So that is called as reorder quantity. Now the order, when it is placed for the number of units, how many units should be purchased is the concept of reorder quantity. So reorder quantity also can be called as economic order quantity. A quantity which is ordered also should be economic in nature. The concept is economic order quantity is a order of the quantity which is ordered. The order for the quantity of material which is placed should be economic. Economic is which should save the cost. Economic in nature. So economic order quantity. That's the concept. For the inventory, broadly speaking, there are three costs of inventory which are incurred. That is the cost of material. First one is the cost of material. Every time when an order is placed, the ordering cost, the cost of the order. Ordering cost is like the procedure I have mentioned, that suppliers are asked to, I mean, they are contacted, they're asked to present their quotation, then selecting them, and then so there are certain costs which are involved. Maybe a person who's appointed to take care of placing an order, so the salary of that person, the communication charges, postage, those charges. Um, I mean, the procedure which is involved in asking the suppliers to take up the I mean, fill the tender requirements, then selection of the supplier, placing an order with the supplier. All that will come under ordering cost. So first is the cost of material. Second one is ordering cost. The third one is after the material is received, the material has to be stored. Stored is, we call it as storage cost. The third one is storage cost. So there are three different types of costs. Okay. First is annually how many units are required. That is the total amount of material which is purchased. That is the cost of material. So in any case, whether it is purchased one time, two times, or any n number of times, that this is the cost of material which will be incurred. Then if they, let's say that annual whatever is the requirement for that, if they go with placing only one order per annum, so the ordering cost will be only to that extent, only once. But one order, they have to purchase huge amount of material, large quantity of material has to be purchased, so their storage cost will increase. If the ordering cost, if the number of orders placed are low, Then we see that their storage cost, we also call, there's another term for storage cost called as holding costs, carrying costs. These are other terms which are used. Okay. So if the ordering cost is low, storage cost will be high. If they want to reduce their storage cost, that is purchase in small quantities, so measures to store them, the cost which to store small quantity of material also will be less, because less space will be needed, less bins, racks, shelves will be needed, few people to take care of the material, um, less measures to safeguard the material in the stores department. So if storage costs are reduced, which means that more number of time orders have to be placed. So the ordering cost keeps increasing. So for the cost of material which is consumed during one annual period, so that 1 year, uh, that cost would be there. But now we have to balance between the ordering cost and the holding cost. So less number of orders, more is the storage cost, because huge quantity for the total requirement has to be ordered, and that has to be stored. Storage cost increase. If more number of orders are placed, it can be purchased in small quantities, so small quantities to store them in the stores department will be less. So what is the ideal quantity? The economic order quantity is given to us by an equation called as under root 2CO divide 2CO by I, or the material, each textbook, the material, the variables which are used are different. Doesn't matter what is the variable which you write, it is only that we need to see that under root 2 into the CO is the order cost per order, and D is the annual demand for the total number of units. So annual consumption, annual demand, annual requirement of material, so however we present that. So the total amount of material, it should be split into the number of orders. So cost per order. So the cost per order into the total number of units divided by what is the cost of holding one unit for 1 year. That is storage cost. So storage cost is cost of holding one unit for 1 year. That is in the denominator CH, holding cost, and Q is equal to quantity ordered. Okay. If buffer inventory held, holding cost is equal to, this is the equation. So here what we are trying to understand is, with the help of this equation, EOQ is equal to this equation, we decide on how many units should be ordered every time there is an order placed. Reorder quantity or economic order quantity talks about the number of units which should be ordered every time there is an order placed. So which also should be economic in nature. So there should be a balance between these two types of cost, that is the ordering cost and the storage cost. Okay, we'll look at some questions, few questions we'll solve based on this particular explanation, and then we'll go ahead with the other explanation of inventory levels. There is one question here on the screen. Um, the following information has been the following information has been calculated for D company. Trade receivables collection period, raw material inventory turnover period, work in progress inventory turnover period, trade payable payment period, finished goods inventory turnover period, 6 weeks. What is the length of the working capital cycle? Can you calculate that? What is the length of the working capital cycle?
17 weeks.
Okay, how 17 weeks?
We
Please
will
elaborate on the answer.
Ma'am, we will add up the trade receivable collection period plus the inventory turnover period, that is raw material inventory turnover period plus work in progress plus finished goods minus trade payable
Okay,
payment.
okay. So only one has to be uh, negative one. The rest of them have to be added up. So you got it as 17. Yes, okay, 17. Um, we'll see 51 question.
Ma'am, can you please go back to the previous question?
One second. One second. A company 49, look into that. A company sells inventory for cash to a customer. I hope all of you have this exam kit with you. Do you have the exam kit with you?
Ma'am, is this Kaplan or BPP?
Kaplan.
Yes, we have, I think.
Yes, ma'am, we have.
Okay. See, your college, whatever is the material which is provided to you, it is your responsibility because you are the ones ultimately writing the exam. It is your responsibility that you work out these questions. So any faculty can only guide you, deliver the content, but the practice part of it lies with the student. So that part, at least for the professional exams, we cannot. I mean, keep looking at someone to spoon feed us because the content is vast, and unless and until the student works out these questions, the logic doesn't set in the mind. So you have to work out um, college level. See, because there are other students also not pursuing the professional programs also would be there, therefore at the graduation level the material will be used. So for you to get a mastery over the content and have good experience of working out these questions, you need to uh, at, at least one material you have to work out. Okay, if not this one BPP material is also almost on par with this one. So either this one or that one, it is your responsibility. So find some time during a day, allot it to the preparation of these things. Don't wait till until the examination date comes closer and then start with that. So every single day work out something from this. There is so much to work out because there are hundreds of questions. This particular material itself has all categories of questions: small questions, medium size, long answers, case study questions also. All categories are there in this particular material. So every single day some part of it you work out, at least one question you work out, so that you would be in touch with this material. And FM is not at a very basic level. It is little at an advanced level only. So you should have a mastery over the subject, right? Then a company sells inventory for cash to a customer. 49th question I'm reading. At a selling price which is below the cost of the inventory items. How will this transaction affect the current ratio and the quick ratio immediately after the transaction? Indicate by clicking in the relevant boxes whether each ratio will increase or decrease. A company a company sells inventory for cash to a customer at a selling price which is below the cost of inventory, at a price which is below the cost of inventory items. So there are two things which are asked. What is current ratio? What is quick ratio? What will the impact be? Whether the impact is, what is current ratio? First thing, current ratio is equal to current assets by current liabilities. Current assets divided by current liabilities. And then this one is quick ratio is equal to quick assets divided by current liabilities, both the cases. How do we figure it out?
Ma'am, current ratio will decrease and the quick ratio will increase.
Current ratio decreases. Why?
Ma'am, because whenever this transaction will be done, the cash will be received and our inventory will decrease.
Huh.
The cash received is comparatively less than the inventory cost, as they have said that the selling price which is below the cost of inventory. So the numerator will decrease.
Numerator decreases. So everything is happening in the numerator only. There is nothing with the denominator. So now, because it is sold below the cost, so the one item from inventory, it is moving to cash. So overall, if it is at cost value, there would be absolutely no impact. Inventory is going out, and then it is coming back in the form of cash. But here we see that inventory is sold below the cost price, so less amount of cash is coming in, numerator is reducing, absolutely correct, in it decreases. But here in case inventory is not the criteria, inventory is going out, inventory is not included in quick assets, it's only that the cash is coming in, so the numerator is increasing, therefore the quick ratio increases. So logically we need to present it and then answer the question. So there's a balance sheet given. A company has the following summarized statement of financial position as at 31st December 20x4. There are non-current assets. Then we have current assets. Current assets, under that we have inventory, receivables, and cash. Current liabilities and net current assets. Uh, the net current assets are current assets minus current liabilities. Net current assets are also called as net working capital. Over the next year, the company should double its sales. The company does not plan to invest in any new non-current assets, but inventories, receivables, and payables should all move in line with sales. What cash balance in 1 year's time would this imply if the non-current assets were all land, no new capital was raised, and all profits were paid out of paid out as dividends? What cash balance in 1 year's time would this imply if non-current assets were all land, no new capital was raised, and all profits were paid out as dividend? So, what does it? I should show the entire screen. The question is there completely. How would we work it out? So, next, this is the current year. Have two columns for the next year. This is current year, and this would be next year. So next year,
Excuse me, ma'am.
yeah.
Can you please explain the meaning of last line? Should all move into line with sales.
This one, what cash balance in 1 year's time, or this one? You're talking.
No, no.
Yeah.
Yeah, this one, this one. Above, yes.
Let me zoom it. What cash balance in 1 year's time would this imply? If the non-current assets were all land, no new capital was raised, and all profits were paid out as dividend. 1 year's period is next year. In 1 year's period, so next year. So if you can write one more column next to this balance sheet. See, we already have current year's values, the the column, and we have working capital finally. So if we can have one more column for the next year, what will happen in the next year? What cash balance? So how much cash would be required? What cash balance in 1 year's time would this imply? Yes, Ashley?
Ma'am, if we double up our inventories, receivable and payable, will it affect our net current assets? Will it get doubled or will it remain same?
Over the next year, the company should double its sales. The company does not plan to invest anything in non-current assets. So all that investment will be, see, whatever the doubling of the sales, they will be investing only in the current assets. So only the inventory and the receivables, that part only. So there is very specifically given that no investment into fixed assets will be made, right? But inventories, receivables, and payables should all move in line with sales. They also have to be doubled in line with sales. So in that case, what will happen to, the question says no new capital was raised and all profits were paid out as dividends. What will happen to the cash balance? Cash balance in 1 year's time. So 1 year's time, we can take it as next year. So I'll write the solution here only. If this is current year, then let's put it as next year. So the non-current assets, what will happen to the non-current assets? What will happen to the current assets is what we have to write. So it's clearly mentioned that the non-current assets will not be, any investment into non-current assets will not be made is what is clearly mentioned. So this will remain same 1000. Coming to the current assets. So what will happen to the current assets? Current assets will double, inventory will double, receivable will double. But see, cash cannot be doubled because that is what is the arrangement which has to be made. So if inventory is double, this will become 400. Receivables double, this also will become double. That is 300, 150, 300. Okay, cash balance as of now, we still do not know. Then, and payables also will go in line. So payables will be cash, we still do not know. So we are putting it on hold. The payables will double. So this becomes 400. Payables 200 will become 400. Fine. Then the net current assets, there's nothing mentioned that net current assets also will be doubled. So net current assets will remain as it is. So net current assets, if it is 250, net current assets is what? It is working capital, isn't it? So working capital is equal to current assets minus current liabilities. Um, Current assets we do not know because there is one thing which we have kept it as on hold, that is cash balance. Current assets minus current liabilities is equal to 250. One thing we know that current liabilities is 400. As of now we see that the as of now we see that the two items of current assets of 400 and 300, 700, and this is 400. So 700, 400. Okay, the difference we see that it is 300. 700 minus 400 will be 300, but net current assets is only 250. So what do we see? We see that there is no cash balance, but there is an overdraft. So here we have to identify that there is additional requirement for the cash amount. There is definitely no amount of, because this itself is already 700 and this is 400. It should be only 250. So this 250 can be possible only when there is a 50 presented here, and 50 on the current liability side is an overdraft. Okay, so this will become 250 in that case. So um, what is the requirement of cash? Is cash is required to be raised to the extent of 50. So 50 will, yeah, answer is that 50 will be the overdraft. What cash balance in 1 year's time would this imply? If the non-current assets were all land, no new capital was raised, and all profits were paid out of dividend. Alternative is, instead of raising overdraft, if at all, if they are raising additional capital, then also it can be managed. But they are very particular that no other type of capital will be raised. So it will be only possible by raising overdraft. So that's why overdraft of 50 would be raised. Quickly, 51. I hope it is clear, all of you. 50, question number 50. Uh, 50, is it clear?
Yes, ma'am.
You want to copy down? Ma'am, you're not audible. Sorry about that. Sorry about that. Okay. 51st question we are, I'm really sorry about the 51st question. It says that Gold Star has an accounts receivable turnover of 10.5 times, inventory turnover of 4 times, and payables turnover of 8 times. And we are asked to calculate what is cash operating cycle in days to the nearest days. So the turnover ratios are only given as number of times. It's not expressed as number of days. So if it is given as number of times, and the answer is in terms of number of days, first we need to convert all these variables into the number of days. So receivables is 10.5 times, should be converted into receivable days. Then inventory also is given as 4 times, should be converted as inventory days. And then payables will also have to be converted into number of days. The way in which we convert it into number of days will be 365 divided by the turnover ratio. Turnover, first one, it is 10.5. So 365 divided by 10.5 plus 365 divided by 4. Then we have minus payables turnover ratio, which is 365 divided by 8. So solve this and tell me what's the answer.
80 days.
80 days. Okay. We have another half an hour time. We'll see some more explanation from this. Um, After that, see, after we do this explanation today, so maybe tomorrow also we will spend on working capital only. And the rest of the time in the class, we will work out many questions. There are many more things which have to be learned under working capital. After that, we will work out questions. Then day after, I mean, the next class onwards, we will see the next topic. After we finish the entire content, the remaining amount of time, so altogether we have 30 hours. So 15 days are there. So if we finish with the PPT and the contents which are there in the PPT, the rest of the time we will allocate to solving questions from each section. As many as possible, we will work out. Fine. The next topic is inventory management systems. Inventory management systems. There are two different types of inventory management systems. One is called as perpetual inventory system. Second one is called as periodic inventory system. Perpetual is after every single entry or transaction about inventory, there is valuation of the inventory. So let's say after a lot of material is purchased, one lot of material, okay, is purchased. So there is an entry made into the stores ledger, and what is the total value of inventory after this purchase is included is valued. Next, let's say after the next transaction after that date is about a sale transaction. So the number of units which are issued or sale or a production requirement met. So the number of units which are issued will be accounted, and finally what is the balance which is available is again recorded in the balance. So after every single transaction, whether it is purchase or whether it is issue of material, the value of inventory is known after the transaction. So there is a constant valuation taking place. Constantly they're looking into what is happening with the inventory. The valuation is taken up. So um, The advantage is they understand what is the availability of material, and then they can place orders. They can see that there is no misplacing of the material. All those things are fine. Those are advantages. But the disadvantages, um, it's time consuming. After every transaction, if the valuation has to be taken up, it is time consuming in nature. Instead of that, instead of valuing the inventory after every single transaction, they wait until the end of a particular period. At the end of the period, they physically count how many units are present in the stores department, and then calculate what is the cost of goods sold. So, if it is a period, if it is a perpetual inventory system, so the opening balance, what they have, the opening balance plus every purchase. So this is the total quantity which is available. Out of that, if there is any issue which is made, issue could be on account of going to the production department or they are selling. So it could be cost of goods sold also. Whatever is that, that is deducted, and they find out what is the closing balance. So the valuation is constant, continuously it takes place. This is called as perpetual inventory system. But if it is a periodic inventory system, the name itself says that they do not value continuously, they value only once in a period of time. So how frequently will they value that? It differs from uh, in business to business, industry to industry, the type of material. So some of them have to be constantly taken care of it. So more number of times inventory would be valued. Some of them which are just dumped in the stores department, not much in importance is to be given. It can be counted at the end of a particular period and then valued. So depending on the nature of material. So periodic review talks about inventory levels are reviewed at fixed intervals. So here what is done is they count the physical number of units. So they the availability is the opening stock is available plus the new purchases which are made are available. This is the total availability of material at the beginning of the period and purchases throughout the period. So total availability during the period from this, because at the end of the period they would count the physical units. The closing stock is known, so they deduct what is the value of closing stock, and they can find out what is the value of cost of goods sold. That is in case of a periodic review. So this becomes cost of goods sold. Okay, opening stock plus purchases minus closing stock is equal to cost of goods sold. So this is periodic review. This is in terms of inventory management systems. One is a perpetual, continuously the valuation is taken place, and the other one is periodic. At the end of a period, the valuation takes place. Done. I sometime back I explained to you how the material is purchased. What is the way in which material is purchased? Suppliers are asked to present their quotations. Supplier is selected. Order is placed. When the order is placed, material is received, stored in the stores department. From stores department, material is moved to the production department. Production takes place, moved to the warehouses or showrooms, and kept available for the customers to buy. That is the conventional method. That is the traditional conventional method of managing the inventory. So we see that that is how it happens. So the day when they purchase material, they are not sure whether the customers will come and purchase. Some anticipation estimations or predictions about the budget, about the demand, they predict what would be the demand in future. To meet the demand, production is taken up. To meet the production, purchases are made, and the rest of it is we understand. So all these activities are based on a prediction, a forecast for the future. They predict what would be the demand which will be there in the future. To meet the demand, the production is taken up. To meet the production, purchases are made. To make the purchases, suppliers are contacted, and this is the procedure. So what are they doing? They are preparing themselves to meet the future. So material is purchased and stored. So therefore, they are investing amount into material. They are spending cost of finance. They are also spending cost of storage. There are costs which are incurred. even before any revenue is realized. So even without knowing that there will be an order from the customer, all this is taken up in the business. That is the conventional way of doing business. We have a modern accounting method of inventory. We call it as just in time. Just in time is contradicting to the conventional method. Conventional method, we see that there are two types of costs which are incurred: cost of finance and cost of storage. So we see these two costs are incurred. To eliminate these costs, the modern accounting or inventory method of JIT, which is also called as just in time, uh, it aims for elimination of inventory. No need to store any inventory. Finished goods are made to order, and inventory, raw material inventory is delivered to point of use when needed. So how does this work? How is it in contradiction to the conventional method? So just in time, um, the conventional is the business, the purchase department. Purchase department places an order with the supplier. Supplier material supplies the material. The material is moved to the stores department. Okay, stores department. From the stores department, it is moved to the production department. Production is taken up, and that is moved to the, let's say it is moved to the showroom. Showroom, from the showroom, I'll write it here, showroom. And from the showroom, the customer approaches, and then there is an order placed. So also we can call it as customer. This is the cycle. So JIT. So how does JIT work? They wait until the customer places an order. When the customer places an order for material, then they take up the production. The material is produced, the finished goods are produced. But to produce the product, material is needed. But nothing is beforehand purchased, like they purchase and keep it available. That purchase is not taken up in JIT system. So if production has to be taken up, then they need material. So they approach the purchase department. So now the purchase department has to purchase the material. So they approach the suppliers. So, and the suppliers, on receiving the order, they supply the material. So just at the right time, just in time, order is received from the customer. To fulfill the order, production is taken up. To fulfill the production, purchases are made. To fulfill that purchases amount, they need to approach the supplier. Supplier instantly delivers the material to the purchase department, and then the stores department. They are moved to the production department, and the production department takes takes up the production, and then they deliver to the customer. So everything happens very quickly, instantly, everything works out. So here they need not log their amount of funds into the material. It is all done immediately, instantly it is done. So they can avoid that cost of finance, that is not needed. Since they are not buying the material and storing in the stores department, storage cost also can be eliminated. So how does it actually work out? How does it happen? So because everything is happening just in time, the whole system itself is called a just in time system. Just in time production happens, just in time purchases happens. Okay, so the whole system is called a just in time system. Sounds quite interesting, but there are many technicalities which have to be looked into in this case. We from the beginning of the class we've been discussing that receiving material from the supplier is a time consuming process, because the supplier has to be selected in terms of various aspects. After the supplier is selected, then order is placed. So that is the procedure. So here in a JIT system, they select the supplier beforehand in terms of what is their requirement, and what would the supplier be able to supply. So the supplier is selected beforehand, pre-selected. And the one who is reliable, that is, whenever they require material, the supplier should be in a position to supply the material. So the supplier happens to be a reliable supplier as well. Fine. So whenever there is a requirement, the material is received from the supplier. Second, production is a complicated process. It requires multiple skills. Many workers with different skill sets are needed, and each one of them is specialized in one area, one type of work. So if at all, if they go for a just-in-time system, the production, the entire production place is considered as one workplace or one single cell. So in that single cell, all the workers are multi-skilled workers, which means that they understand to operate every type of machinery. They can take up every type of work which is needed in the production. So anyone can replace every worker can replace any other worker. So even if on account of absenteeism someone is not present also, the ones who are present can fill the gap, and they can take up that work of the person who's absent. Okay. So that is how the production is taken up, so that they save time. They can reduce the time to produce, and are in a position to deliver the production to the customers. Fine. So here it is in a reverse direction. They wait until an order is received from the customer. To fulfill the order, production is taken up. To fulfill the production, purchases are made, and the purchases are made from a reliable supplier who supplies. Then that is moved to the production department. Production is completed because the workers are multi-skilled, and the order is delivered to the customer. So the time period is reduced. No need to invest anything. Funds can be quickly converted into, I mean, the turnover happens very quickly. Turnover is quite high. Fine. Storage costs can be avoided. So here it says that aims for elimination of inventory. Finished goods made to order. So the production is taken up only when there is an order placed. Raw material inventory is delivered to the point of use when needed. So raw material, the supplier supplies whenever they need that. So on placing an order, the supplier supplies the material to the purchase department. I hope it is clear. JIT system.
Yes, ma'am.
Yes,
Yes,
ma'am.
ma'am.
Then accounts receivable. Accounts receivable are the accounts of receivables, because a transaction took place on account. Account is credit. So because the transaction took place on credit, the business is entitled to receive something. So receivables, accounts receivable. So when does it happen? So when they have a credit policy to sell goods on credit basis. But to whom are the goods sold on credit basis? After the credit worthiness of the customers is tested, it is evaluated. So the the credit policy or the credit feature is extended to the customer. It is not offered to everyone, but on knowing about the credit worthiness of the individual, credit facilities provided to that individual. Then it also there is a control on the credit limit. How much credit should be provided? Also, there are credit limits. Then invoice promptly and collect overdue debts. So the on credit sale, there is an invoice which is received from the customer based on the invoice. So on the due date, the invoice is presented to the customer. As against the invoice, the amounts are collected from the customer. So invoice promptly and collect overdue debts. Then the reminders about making the payment. So follow up procedures are there. Monitoring the credit system from time to time. If there is any revision which needs to be made, some strategies have to be altered. That is monitoring the credit system. And once in a while there are discount offers also. So I'll discuss that about discount offers in detail in some other topic. So we will see that. The next topic is prompt payment discounts. Prompt payment discounts is first thing. We are talking about credit sales. We are talking about accounts receivable. Receivables, because goods are sold on credit basis. So if they are entitled to receive, if they have that benefit of receiving it in future, because the transaction are was on credit. Right. Why do the business sell on credit basis? The reason why the goods are sold on credit basis, sometime back we have discussed that will increase the sales. So increase in sales is the benefit what they will receive if the goods are sold on credit basis. If sales are on credit, the benefit is increase in sales done. But along with this benefit, there is something else also which comes um, along with that, which is the operating cycle is extended. When operating cycle is extended, the cost of finance extends, the cost of finance increases, the storage cost also increases. So benefit is good, that is more number of sales are made. But they have other things also associated with that. Their costs are increasing, cost of finance, cost of storage is increasing. Apart from that, their liquidity also gets affected because cash is not available with them. The operating cycle has extended. So what what was to be as small as this, because of the credit period, it has extended, it has become bigger. So if cash is made into raw material gets converted into finished goods. As soon as the finished goods are sold, cash should be received. But this finished goods are now converted into receivables, accounts receivable. So it is extending. When it is extending, their funds are blocked. So that affects their liquidity position. When that affects their liquidity position, they are short of funds. They cannot have the funds available with them. So what they have to do is go in and borrow funds from another source. So that again will increase their cost of finance. So benefit part of it is increased sales, but cost part of it is there are more number of costs which are increased. Therefore, along with this strategy of increasing sales, another second strategy is adopted, that is offering discount to the customers. Let's say the credit transaction, the transaction looks like this. Let's say that there is a sale made for $5,000. I'm writing one example of credit transaction. 2 divided by 10, comma, one more thing recorded as n divided by 30. So there are three items which are recorded, which they are separated by 2 commas. The first one is a sale which took place for 5,000. Then there is one fraction which is there, which is 2 by 10. The last part of it again is a fraction which is given as n by 30. When we look at a sale transaction like this, we understand that this is a credit sale transaction, credit sale. The first one says that this credit sale was worth 5,000. The last part of the fraction, which is n by 30, indicates that a credit period of 30 days is allowed to the customer. So customers can pay within a period of 30 days. In between these two things, we see there is one more fraction which is there, 2 by 10. Customers are allowed to pay in 30 days. So they can pay at the end of 30th day. So the payment can be made. But But if the customers choose to pay before 10 days, within 10 days period, they are entitled to receiving a discount of 2%. So the in between that fraction indicates the percentage of discount which they can avail if the payment is made before the credit period. So before that credit period, another period is mentioned. So if they make the payment within 10 days, they can avail a discount of some percentage. Okay. um, See, sometimes when the payments are to be made, let's say the sometimes at home, if we have to recharge the internet bill, or if we have to pay some cable transaction, recharge them, so they keep coming out with offers. So before the due date only, they recharge them. Some facility is given, some cashback is given, something, some offers are given. So it is attracting them to make the payment before the due date. So now here again we see that if they make the payment before the due date, um, 30 days is the due period, but before 30 days, that is before 10 days, if they make the payment, they are entitled to receiving a discount of 2%. So for that 10 days, so not availing 20 days of credit period is providing them a benefit of 2%. For that 20 days period, if they're foregoing that 20 days credit period, they are availing a discount of 2%. So in a year of 365 days, if we convert that 2% to 1 year period, what is the cost of discount? Annual cost of discount. That's the logic there. The annual cost of discount, this is the formula given. The formula is 1 plus discount. Discount here it would be 2 divided by left amount left to pay. Amount left to pay. Okay, the whole thing to the power of number of periods minus 1, where number of periods is calculated as how many periods is, if the year is taken as 365 days or 52 weeks or 12 months, the way we are presenting the period to be as 365 or 52 or 12 divided by the number of days of that credit facility which is foregone. So number of days, weeks, months earlier that. So whatever is foregone, that 20 days facility is foregone. So divided by that number of days. So proportionately, if they are foregoing that 20 days credit period, okay, and if this is the amount, if this is the percentage of discount given for 20 days, 2% is the discount. For 365 days, when we convert it, what is the percentage of discount? So that is the logic here. So this is given as this formula. So another version, some other versions, the formula is presented in another way, but the logic, the explanation behind this is to make the customers pay promptly within the time or before that. The strategy of selling the credit sales is to increase the sales. That is good. But to meet their liquidity, another strategy is taken up. That is, the next strategy is to make them pay before the due date by giving them some discount. Okay, so that will cost them, but maybe that is better than they paying additional cost of finance. So this cost of discount may be more attractive than paying additional cost of finance. So this is the formula what we would be using. So monetary cost of discount offered is loss of cash received from customers. Monetary benefits of discount offered is reduced receivables balance leads to lower receivables funding costs. Okay, funding cost is average receivables into interest rate. This is the cost which they would be paying to the external entities. But by giving the discount facility, there that also is another cost for them. When discount is given to the customers, that is also a cost for them, right? That cost may be better than this cost which they are paying to the outside um, uh, people from whom they have borrowed the money. Okay, this is the formula which we would be learning. So we'll work out questions on this and the other topics tomorrow. So we will again continue with the working capital and the accounts receivable part only. At least for some time in tomorrow's class, we will be looking into the accounts receivable. After that, we'll go to the payables and the cash management. So I think the entire day for tomorrow also would be working capital only. Right? Then from Monday's class, we will change the topic. Any doubts?
No, ma'am.
Okay. Then I'll wind up the class here and see you tomorrow. Okay. You said you'll find out whether the mail was received for the recording. If you tell me that the recording,
Ma'am, I didn't receive the recording.
uh, who gave me the mail ID? There was some
Me, ma'am, Vani.